In our last video, we had a true random draw of returns. And we saw that year one was scary, right? We went from 2 million to 1.5, and that was a scary thing. But sequence of withdrawal risk did persevere. And if we stayed the course, it worked out okay. But I wanted to show you another scenario where we have persistent negative returns, or perhaps a systematic economic shock that hurts kind of everybody in every asset class. So what I've done then is I've actually arranged the same returns we saw in the same bucket returns. I just moved the order a little bit. So in this case, I took sort of a bad equity market and a bad bond market, so basically 2022, and then we still had monthly withdrawals. And so we can see what happens here is if in year one, you get hit with this negative 18% equity return and the bond pull was negative 13, then we kind of see the stress hit both our stock portfolio and our stock and bond portfolio, right? And why is that scary? That's pretty scary because stocks and bonds are usually considered a pretty safe outcome. So imagine being in this safe outcome and boom, you're down 400 grand. I mean, that's a pretty frightening idea. Well, it's got to get better, right? It's got to get better. Well, it doesn't always get better. So what if year two, we also had some negative returns? So I took the second worst stock return of the set, negative 4.38. I took the second worst bond return of the set, negative 1.5. And now we suddenly see these pull issues happening again, where now your equities are down to 1.38 million. And this is only your second year of retirement. You're down $620,000. In a 60-40 portfolio, it's not as bad, but not looking great. And then in your blended portfolio with land, you can see it's a bit more resilient. And then in year three, I went ahead and pulled the third worst stock pull in the bucket and the third worst bond pull in the bucket. And we wound up then with about 1.2. So at this point, there's got to be panic, right? You're at 1.2 million. You started with 2. You're 3 years in. You may still live another 27 years. Things have gone awry, okay? Well, what does happen though? The market was resilient. In this case, these high equity premiums we've had the last few years do pull it together. And you do wind up with like 2.3 million. So there's something for staying the course. But at the same time, I think even as a financial planner, my fiduciary duty to you, I'm looking at 1.26, and I'm probably going to change your plan a little bit. This goes to show that sequence risk really matters. And just for giggles, in 2008, we had a negative 38% return. I think it was like 38.7. What does that do? And boom, you crater this thing. You actually wind up losing over $1 million by year three. Now, am I trying to do this to scare you? No, I'm not trying to do this to scare you, but I'm trying to do this to say the sequence of losses matters. And when you have losses up front, that's a much scarier position to be in. And how do we avert some of those losses up front? We diversify. We look at buckets with other asset classes. And in this case, land is not sexy. It is not exciting. It's not going to get you a 28% return, but consistency and positive are there. So having that consistent positive bucket along with your stocks and bonds goes a long way. One other thing to show, we'll go ahead and we'll kick back that issue with the stocks. So this is the same bucket withdrawals we've had. If you'll notice, these geometric means are identical to our first pull. Our stock means the same, bond means the same, land means the same, but the outcomes are wildly different, right? So that just goes to show you can take a bunch of numbers and find their mean. It doesn't actually have anything to do with the outcome the client faces. Notice the correlation metrics is drastically different. Of course, I pulled negatives together and positives together, but kind of clever on that end. And then last but not least, the actual returns to the client were dramatically different than our first random draw with our equity portfolio at 6. And if you remember, the first random draw had the equity portfolio a bit higher, coming in at 8. And so I think that's worth noting, right? Based on how I sequence the returns, risks, and withdrawals, could be 8, could be 6, could be 4, could be 3, could be 2. And those are all things to think about as we do a financial plan. But to close, sequence of return risk, sequence of withdrawal risk is a big issue. We can get around it by 1, possibly annuitizing some of this. 2, lowering our withdrawal rate, right? If we're only pulling 3.5% out of the portfolio, we don't really worry as much about the outcomes, and you'll see it never gets quite as bad. The other issue is to annuitize. Take some of this off the table, build an income stream, and then that puts less pressure on what's left. But that's how we address the risk, and I hope this exercise has kind of given you a little more understanding of why this is an issue in retirement planning.